Tamilnad Mercantile Bank that has posted a good set coming in there. In fact, we do see the NII rising on a year-on-year basis with stable asset quality. But let's also talk to the management and get a sense of what's in store for the bank. For that, Mr. Salee S. Nair, MD and CEO Tamilnad Mercantile Bank, is now joining us. Hello, good afternoon, Mr. Nair, and thank you so much for joining us on ET Now. Well, firstly, sir, your NIMs have expanded despite the rising deposit costs. What were the key drivers and how much of this improvement is sustainable?
Yes, on the NIM, yes, you are right that the deposit costs are rising across the industry, and it is so for us as well. But we had the advantage this quarter of a repricing of our earlier deposits, which were at a slightly higher elevated cost. So if you look at it, the cost of deposits for the quarter actually declined. It was 4.71% earlier. It has come down to 4.68%. This is on the basis of the repricing of earlier deposits. But going forward, as you rightly said, there is a bit of a hardening of it. I think we were seeing, in the 4.7, 4.75% kind of range, the cost of deposits settling for the year. And the NIM, as a consequence of that, has improved. In fact, we anticipated a rising cost in deposits, and we tweaked around our advanced portfolio to generate that little bit of extra yield. And that you see that it has gone up from 9.93% to 10.10% in the quarter. That is a 17 basis. So the combination of a reduction in the cost of deposits and a rise in yield has resulted in 4.29%. But going forward in the current year, like I said, we anticipate a bit of rise in deposit cost, and which means there will be a small reduction in the NIM, but I expect it to be well above 4%.
Right. Mr. Nair, the advances have also consistently outpaced the deposits. What is your comfortable CD ratio, and how do you plan to fund future credit growth without materially increasing the funding costs?
Look at our balance sheet. If you look at our balance sheet, we are a well-capitalized bank. I think one of the highest capital ratios and one of the highest leverage ratios. Our leverage ratio, if you look at it, is at 12.5%. And on the net worth share, the equity and reserve share in the balance sheet is higher, upwards of 13%. So that gives us enormous leeway as far as CD ratio is concerned. Our current CD ratio is 89%. And we have done some internal calculations, which of course we have put out in the public domain as well. As of the 30th of June, given the balance sheet size and the composition of the balance sheet, we can go up to 99% of the deposits in terms of CD ratio. Look at it, that is 99%. So we have quite a significant way to cover. And having said that, I think our comfort level on CD ratio would be in the, we certainly would like to keep some liquidity as cushion going forward, not to eat up the entire, the deposits. So our comfort level will be the 93-94% range.
Right. So although the CASA declined sequentially while term deposits drove the overall growth, what initiatives are underway to improve the CASA mobilization?
CASA, as you rightly said, has sequentially declined. But look at the overall deposit growth. It is 19 or 20%. And more importantly, look at our term deposit growth. It is 20%, well past 20%. What we have done in the quarter is anticipating a slight hardening of rates, and also bit of a challenge on the deposit. We were focused on securing our resource base. And that was focusing on slightly longer term deposits. And to some extent, that seems to have canalized, very clearly seems to have canalized the CASA. CASA has declined about 500 crores during the quarter. But I mean, we have had a record deposit growth overall, riding on the long-term deposits, long-term term deposit. Let me also add you that we have also been focusing on the non-callable deposits, which grew 18% quarter on quarter. From 31st March 26, it grew 18%. And 80% of the non-callable deposit is 1 year and above. So this quarter, we have been trying to secure our deposit base, secure our resource base, and that has cannibalized CASA in some way. A bit of a cannibalization has happened. But going forward, we propose to correct that. We intend to focus equally on both the CASA and the term deposit side. And the TBG is getting strengthened. We have already launched the TBG, as I mentioned last year, the transaction business group. It is getting strengthened. Our own branch network is being strengthened to reach out to the existing CASA base. And you will see that turnaround happen in this quarter, in quarter 2 of this year.
Right. Mr. Nair, also the bank has consistently delivered over 25% loan growth, and you have indicated that a CD ratio of 94 to 95% is comfortable. Now, given this, how sustainable is the current pace of advances growth?
This growth momentum certainly 20% plus loan growth, advance growth is something that we are aiming for. The 27% growth also came on the fact that the gold loan portfolio, which is about 46-47% of our portfolio, contributed substantially more than the other segments. I don't find that the gold loan portfolio contributing in that measure going forward, given the fact that the gold prices have somewhat stabilized. But 22% advance growth is something that we are committed to defend for the year.
Right. Also, the gold loans account for a significant portion of the portfolio. How sensitive is the book to any sharp correction in the gold prices, and have you observed any changes in customer behavior?
See, yes, the gold loan portfolio for us is a significant portfolio. And like I said, there is some tapering of gold loan growth itself that I see. On the stress side, we are monitoring the gold prices on a daily basis, and we are subjecting our gold loan portfolio to sensitivity analysis on a daily basis. And as of today, a reduction in the gold prices of 20% is something that we can take in our stride and yet ensure that we have 100% cover in terms of gold value of our loans. So I think this is a portfolio that we are quite confident of, and going forward, like I said, we will continue to focus on it and to see that it gives us the kind of return that is generating hitherto. In some, I wouldn't call it that way. Like I said, the flow of customers for gold loans has not stopped. Earlier, you had a per gram advantage, which the customer used to take note of it. But now it is going to be for the same, as they want more and more, it is going to be a volume game. They have to put in more gold. I think that's something that the customer is increasingly becoming aware, but the flow has not really ebbed at all.
Right. So have you started seeing any competitive pressure on the deposit pricing from the larger private banks?
See, we are still, the size of our bank is still relatively small. From that perspective, the incremental growth in the liquidity, in the deposit in the country, its larger slice is something that nobody will notice when we take it. So from that aspect, I don't think we are facing any kind of competition. If you are facing a competition, let me tell you, we would not have delivered the 20% kind of nearly 20% growth in deposits that we delivered.
Right. Mr. Nair, while the GNPA continues to decline, fresh slippages have increased sequentially. Is this seasonal, or does it indicate early stress in any portfolio? No, in fact, we tackle it on two fronts. The SMA front, which is the 1 day delinquency to 90 days, and the NPA front. On the NPA, I don't see we are seeing any kind of, in fact, it is stable, right? I think quarter on quarter, even when you see it, it has been stable. And you will see that continue going forward. And we have, in fact, said that we will certainly be well below the 1% mark as far as the NPA is concerned. On the SMA space, I think there has been an uptick, slight uptick quarter on quarter. And that's something that we are aware of it. And some of it has come out of the gold loan.
And we have been quick to respond to that. And if you see that, I put it out in the public domain also that the SMA, as after spiking a bit to beyond 2%, has actually now started coming down. And let me tell you, it is still one of the best in the industry.
All right, Mr. Nair, on that note, thank you so much for taking the time out and joining us on ET Now. It was a pleasure to have you on the show. And well,